Good morning and welcome to the Killik & Co Market Update. This is our last video of the year, so we thought we'd try a little bit of a Christmas special. Our research team has been very busy over the last few weeks, picking out their preferred investment themes for next year. So this week for the video, instead of just looking at what's happened over the last week, I thought we would look ahead to some of the key investment themes that Killik & Co will be focusing on in 2022. First up, we've got rising interest rates. Interest rates have been at record low levels since the financial crisis, which is now over a decade ago. But over the last few months, inflation has been rising, and therefore there's been speculation that interest rates will have to rise in order to get that inflation under control. And this week, it's really starting to feel as though these rising interest rates are starting to occur. This week in the UK, on Wednesday, the latest inflation print came in at 5.1%, and the very next day, the Bank of England voted to raise interest rates from 0.1% to 0.25%. Also this week, the Federal Reserve in the US has commented that they expect to see 3 interest rate rises in 2022. So what tends to happen when interest rates are rising or when they're expected to rise? Well, usually we see an increase in the traded volume of interest rate derivatives, for example, futures and options. And these can help businesses to protect themselves against adverse moves in interest rates, or they can help speculative investors to make money from these moves in interest rates. So here's some data that we've taken from CME, which is the largest derivatives exchange in the world, and it shows the increases in the traded volumes of some of these products between the third quarter of last year and the third quarter of this year. So as you can see, these moves in volume are very large indeed. For example, there's been a 111% increase in the traded volume of euro-dollar options. So please do give us a call if you'd like to hear about how to feature this in your investment portfolio. Next up, we have electric vehicles, which is a theme that has been talked about a lot over the last few years, but most of us still don't have electric vehicles, and therefore there is still a significant growth opportunity here. Here's some data showing UK vehicle registrations between last year and this year, and it breaks it down by vehicle type. So as you can see, there's been a big drop-off in the number of new diesel vehicles being registered, but a big increase in the number of new battery electric vehicles being registered. However, petrol is still far and away the biggest category, which shows that there's still a significant growth opportunity for battery electric vehicles. So, how can you invest in battery electric vehicles? Well, one option is clearly to buy the manufacturers of these electric vehicles, but another is to buy the companies making the components that are needed for these electric vehicles. For example, the companies making the semiconductors. And yet another way is to invest in the companies producing the raw materials for these electric vehicles. For example, copper and the various metals that are needed. So do give us a call if you'd like to talk about this theme in more detail. Decarbonisation and renewable power are likely to remain big topics over the next couple of years, and there's lots of talk about how we should be using electricity and not fossil fuels to power our cars, our homes and our businesses. However, if this electricity is not coming from renewable sources, then it's not going to make a huge amount of difference. Here's a chart showing where the world's electricity is currently being generated from, and as you can see, 35% of the world's electricity currently comes from the burning of coal, and a further 23% currently comes from the burning of natural gas. So as you can see, a huge amount of work still needs to be done in terms of investing in our renewable capacity, but also investing into our electricity networks, firstly so they're better able to deal with power from different sources such as renewables, and secondly so they're able to deal with a much greater volume of electricity if that is going to be our main source of power going forward. The volumes of data that we're creating is growing on a daily basis as more and more devices are connected to computers and to the internet. Here's a chart that estimates the annual levels of data being created, and as you can see, there was a big jump between 2019 and 2020 as more of us were forced to work and shop from home. As you can see by the chart, the level of data created in 2025 is expected to be more than 4 times the amount of data created in 2019. And all this data generation is creating a huge opportunity for companies involved in the capture, the storage, and more importantly, the analysis of this data. There are lots of companies on this list, so please do give us a call to talk about these in more detail. Next up, we have online retail. Back in 2019, before the pandemic, less than 14% of the world's total retail sales took place online. Thanks to lockdown and the fact that we were all forced to shop from home, that figure has now jumped to over 18%. But what's happening online now is that it's becoming a very crowded space with lots of brands fighting for attention. Imagine you're shopping on Ocado or Amazon or Google, you type in what you're looking for, and you probably don't look past the first page of results. Most people, in fact, don't look past the first 2 results. So from an investment point of view, we need to be looking for the big brands with the money and the marketing spend to get themselves to the top of that search list. So do give us a call if you'd like to talk about who we think those big brands might be. Next up, we have healthcare. The world has an ageing population, and what's more, the level of treatments available is becoming more advanced. So we have more and more people needing treatments, but also a greater number of ailments that can be treated. So the upshot is that more and more is being spent on healthcare worldwide. Here's a chart comparing the healthcare spending per person in the UK and the US on an annual basis since the year 2000. As you can see, both countries have more than doubled their spending per person in this time period, but spending in the US is particularly high. And spending in the US is expected to hit 18% of gross domestic product this year, and that's up from just 5% in the 1960s. So this level of spending growth is simply unsustainable. So what can be done aside from spending more and more money on drugs and pharmaceuticals? Well, one option is to invest more in things like medical devices, which could help some patients to better manage their conditions, keeping them out of hospital for longer and therefore lowering costs. Another is to spend more money on areas such as robotic surgery, which could help to bring down backlogs by helping surgeons to get through more procedures more quickly. So companies exposed to these areas could potentially have a big growth opportunity here. The issue of backlogs in healthcare systems is very topical here in the UK this week because the NHS has just hit a record backlog of 6 million patients. And finally, we'll be looking at emerging global wealth. There are lots of emerging markets around the world whose middle classes are expected to grow significantly over the next 2 decades, and that means that companies selling into these markets could do well because of the growing levels of wealth and the growing levels of discretionary expenditure. A lot of people have been put off investing in emerging markets over the last year because of what's happening in China. As you can see by this chart showing the MSCI China index, Chinese equities have sold off heavily in the last year because of all the new regulations that the Chinese government has been imposing. However, investing in emerging markets does not necessarily mean having to invest in China. Here's a chart showing the country weightings of the MSCI Emerging Markets Index. As you can see, China does make up a third of the index, but there are several other attractive emerging markets, including South Korea and India. Outside of that, it's also possible to invest in the so-called frontier markets, which are so emerging that they're not yet classified as emerging. Examples include Vietnam, which has picked up a lot of export business because other countries have been trying to do less trade with China. So it's important to remember that you can invest in emerging markets without having to have a big focus on China. So that's our roundup of the themes that we'll be focusing on in 2022. Thank you very much to our Chief Investment Officer, Simon Marsh, and our research team, Nick Zieglash, Mark Nelson, Andrew Duncan, Martin Maloney, and Stephen Timoney. Let's just have a quick look at the week ahead before we finish. We're expecting results out from Nike. So aside from that, that just leaves me to wish you a very happy Christmas and New Year, and I look forward to seeing you in the year 2022.